So our expectations for 2014, when we map all this stuff together, is that we all need to taper our enthusiasm a little bit. Yes, we're going to have better global growth, but sentiment was kind of high. We've got the Fed coming off a little bit. You've just got several cross currents that lead us to believe that it could be kind of a choppy year. And since we came in at high valuations, maybe we'd also just calm down a little bit from the euphoria we started the year with. So let's get specific. In terms of equities, we expect earnings to grow, but perhaps valuations to shrink. We expect large companies to outperform small companies. Small caps have gotten pretty expensive, as we've discussed. We believe that the active management style will outperform the passive management style in this sideways market, and Brian's going to talk about that for us. We believe that the internationals, it was Kevin Wilson who said that a broken clock is right twice a day, but we believe that the internationals with the valuations will actually outperform the domestics, and so far 1/6 into the year, they kind of have. In terms of U.S. interest rates, we expect them to be really little change. So even if the Fed does completely come out of the marketplace, the differential between short-term rates and long-term rates is not going to go vertical. And so long-term rates are kind of anchored. So I don't see short-term and long-term rates really going anywhere. In terms of the dollar, if the Fed's committing to reducing its stimulus program, that could help the dollar. So the dollar might go higher. In terms of bonds, because we don't expect rates to change that much, we don't expect bonds to change that much. And my primary thread is just this continued sort of lethargic policy array that's the opposite of kind of what the economics calls for at this very moment.